Nobody needs to break into your account. The system does not need to confiscate your wealth directly. It only needs to make the unit you hold worth less over time, quietly, consistently, and by design. The mechanism is not secret. It is embedded in the architecture of modern monetary policy, and it has been operating without interruption for over a century. You saved the money, you followed the rules, you kept it in an account the institution called safe, but safe and stable are not the same thing. A dollar earning 0.5% annual interest while purchasing power erodes at 4% annually is not safe. It is a slow transfer from your balance sheet to the balance sheet of whoever benefits from inflation first. That is the structural truth most people never encounter, not because it is hidden behind classified documents or private meetings, but because the educational and financial infrastructure you were handed never had an incentive to teach it to you. You were taught to save. You were not taught what saving inside an inflationary monetary system actually means. To understand why your savings erode, you have to understand who designed the system and what they need it to do. Central banks exist officially to maintain price stability and support maximum employment. Those are the mandates stated in law. But there is a third function, one less frequently advertised, which is to manage the cost of sovereign debt. Governments that run persistent fiscal deficits need to borrow continuously. When debt levels grow large enough, the only viable long-term strategy is to keep real interest rates below the nominal rate of economic growth. This is called financial repression. Financial repression means the saver is systematically paid less in real terms than the rate at which their purchasing power decays. It does not require force. It only requires that the Federal Reserve maintain nominal yields low enough and tolerate inflation high enough that the real return on safe assets is negative or negligible. Consider this is not speculation, it is a documented strategy. The term was formalized in academic economics by Carmen Reinhart and Belen S. Brancha. Their 2011 paper through the National Bureau of Economic Research became the definitive reference for how sovereign debt is reduced through financial repression. Their analysis of post-WWII data showed that advanced economies liquidated debt, equivalent to 3–4% of GDP per year, through financial repression. Not through default, but through negative real interest rates imposed on domestic savers. The mechanism works because it is diffuse. The cost is distributed across every holder of cash, bonds, and low-yield savings instruments. No individual bill arrives. No transaction is labeled inflation tax. The value simply diminishes over time, and most people attribute the erosion to personal financial failure rather than systemic design. The Cantillon effect compounds this further. When new money enters the economy, it does not arrive uniformly. It enters through banks, through asset markets, through institutional channels. Those closest to the source of new liquidity benefit first. Asset prices rise before consumer prices do. Those who hold savings in cash receive the price increase later, after their purchasing power has already been diluted. The explicit financial consequence: a saver holding $100,000 in a standard savings account at 0.5% annually, against average inflation of 3.5%, does not end a decade with $100,000 of purchasing power. They end it with the nominal figure largely intact and the real value substantially reduced, approximately $70,000 in today's terms. The number on the screen has not changed. The command over goods, services, and time has. This pattern is not new. It is a recurring feature of monetary systems under fiscal pressure. After World War I, Germany's Weimar Republic pursued aggressive monetary expansion to fund reparations imposed by the Treaty of Versailles. By 1923, the resulting hyperinflation had rendered the German mark essentially worthless. Ordinary citizens who had saved in cash, who had done what they were told, saw their life savings wiped out within months. Those who held hard assets, foreign currency, or real property retained relative purchasing power. The destruction was not accidental. It was the structural result of a government choosing monetary expansion over fiscal restraint, when no other option remained viable. The more relevant parallel for contemporary savers is the post-World War II United States, a period in which the federal government systematically used inflation and interest rate controls to reduce war debt. Debt that had reached approximately 120% of GDP was reduced to roughly 35% over 3.5 decades of sustained fiscal management. This was accomplished substantially through financial repression, by keeping the interest rate paid on domestic savings below the rate of inflation for extended periods. Ordinary savers paid the cost, the government's debt load decreased. The transfer was legal, systematic, and never described to the public in those terms. Alan Greenspan oversaw a prolonged period of monetary expansion and credit cycle management that critics later identified as the structural precondition for the 2008 financial crisis. Sustained low interest rates following the dot-com collapse, accommodative monetary conditions through the early 2000s, these contributed to asset price inflation and the gradual erosion of real returns on conventional savings. Greenspan later acknowledged in congressional testimony that his model of how the financial system self-regulated had contained a flaw, but the structural consequences for savers had already accumulated. The economic parallel to today: the United States currently carries a federal debt load that has returned to levels comparable to the post-World War II period. The incentive structure has not changed. Governments under fiscal pressure historically choose inflation over default, financial repression over explicit taxation. The tools are the same. The institutional actors have simply changed names. When the monetary architecture shifts, when central banks expand balance sheets, when fiscal deficits remain structurally elevated, when real interest rates are suppressed, the consequences distribute unevenly across asset classes. Cash and cash equivalents absorb the most direct erosion. Savings accounts, money market instruments, and short-duration fixed income denominated in fiat currencies lose real value when inflation exceeds nominal yield. This is not a risk that materializes under exceptional circumstances. It has been the default condition across most of the post-2008 period in the United States, Europe, and Japan. Real assets, productive land, commodity-linked instruments, equity in companies with pricing power tend to reprice upward during inflationary regimes, not because they become intrinsically more valuable. Because the unit of account in which they are priced has become less valuable, the asset appears to appreciate. What has actually occurred is that the denominator has shrunk. This creates a second-order effect on wealth distribution. Those who hold financial assets are partially insulated from purchasing power erosion because their assets reprice. Those who hold savings primarily in cash or low-yield deposits absorb the loss directly. Federal Reserve survey data has consistently shown that asset ownership is concentrated in the upper wealth distribution. The mechanics of inflation therefore function as a regressive redistribution mechanism, not by explicit policy intention, but as a structural consequence of how the system allocates the cost of monetary expansion. Ben Bernanke oversaw the most aggressive expansion of the Federal Reserve balance sheet in the institution's history, from approximately $900 billion before the 2008 crisis to over $4.5 trillion by 2014. This was executed through multiple rounds of quantitative easing. The stated objective was financial stability and economic recovery. The structural consequence was a sustained period of near-zero nominal interest rates. Real returns on savings were compressed to negative territory while asset prices recovered and expanded significantly. The gap between those two outcomes was not accidental. Janet Yellen managed the transitional period of policy normalization while navigating elevated public debt and suppressed yields. The structural tension between normalizing rates and managing the cost of sovereign debt financing was explicit in institutional communications during this period. The positioning implication for a rational actor is straightforward. In an environment of structural financial repression, holding wealth exclusively in fiat-denominated savings instruments is a decision to absorb the cost of monetary expansion. Understanding this does not require predicting the precise trajectory of inflation. It requires understanding the incentive structure of the institution setting rates, and the fiscal condition of the government that institution serves. The system has been described, the mechanism is documented, the historical precedents are not obscure. What changes when you understand the structure is not your emotional posture, it is your analytical framework. You stop expecting the savings account to preserve wealth in the way a tool designed for that purpose would. You start asking what the incentive of the institution offering you that account actually is. You begin distinguishing between nominal stability and real stability. This is not an argument for panic. It is not an argument for any specific asset allocation or financial product. Decisions about how to structure a balance sheet depend on individual circumstances, time horizon, and risk tolerance that no general analysis can substitute for. What this analysis does is eliminate the assumption that inaction is a neutral choice. Holding cash in an inflationary monetary system is a decision. It is a decision to absorb purchasing power erosion at the rate the monetary system produces it. Whether that is the right decision in a given context is a question worth asking deliberately. Not because someone told you to be afraid, but because the mechanism warrants that level of attention. The architecture of this system was designed to solve a problem: sovereign debt management under fiscal pressure. It solves that problem effectively. The cost of that solution is distributed to the holders of currency and low-yield savings instruments. That distribution is not incidental, it is structural. Understanding a system does not require opposing it emotionally. It requires seeing it clearly. When you see it clearly, you can respond to it rationally. This is 21 protocol. Freedom is not a feeling, it's a structure. If you don't